Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsors and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's conversation is with Leah Berend of Marrin Investment Partners. But before we get to Leah, we got some new quarterly data from GF Data. Max, would you take us through some of the highlights from that?
So this report is actually the GF Data Small Deals Report from the fourth quarter of 2025. And it has data from all of 2025 and includes 230 transactions. And these deals are sub 25 million or up to 25 million of enterprise value. So these are the sort of smallest level of deals that get reported to GF Data in terms of enterprise value. And so, the highlights are, fairly interesting. There was a bit of a soft landing, I'd say, last year with the valuations of businesses in this size range. And according to GF Data, the average multiple in this size range was 5.9 times EBITDA. And in 2024, it was 6.1. So overall for this data set, it was down just a little bit. But it was still above the longer term average of 5.8x times EBITDA. So for the smallest deals within GF Data, the sub sort of 25 million of EBITDA, valuations are kind of still in line with what they've been historically, but they dropped a little bit from 2024. And of these 230 deals, as you would expect, these are smaller deals within the data set. Of the 230 of them, 70% were actually add-on deals, so bolt-on acquisitions that are added to a sponsor's platform to grow EBITDA and grow capabilities, sort of the buy and build strategy. So within the size range, you got 70% of these deals being bolt-ons, which is to be expected. Platforms obviously are generally larger transactions. Folks are actually paying a little bit more, at least they were last year, for bolt-ons than they were for platforms in this size range. Now, keep in mind, 70% of these are bolt-ons, so it's not a great data comparison from a count standpoint. But for the add-ons, folks were paying about 6 times EBITDA, and sponsors were paying about 5.8 times EBITDA on average for platforms. So it looks like the market cooled a bit. Obviously, you've got mostly platforms in this, or mostly add-ons in this size range, but it'll be interesting to see what's happening in the market in Q1 of this year of 2026. Just anecdotally, from my experience, the market seems to have heated up in terms of deal count this quarter, but we'll see what the data ends up saying here in the coming months as soon as it's available.
And does what GF Data was reporting square with what you saw first person from LCS?
I think so. We did see a lot of add-ons just in general in terms of our scope of work, which makes sense because a lot of our deals are sort of between that $1 to $25 million range of EBITDA. So the 70% being add-ons makes a lot of sense to me. The valuations, it's hard for me to say. I mean, this is the data, so it's correct. I would say we saw valuations just kind of in line with what we usually see, which this basically shows. It just shows sort of a small drop in value, but I'd say it's pretty accurate. And deal count was down last year, and we definitely saw that, especially at the end of last year at the accounting firm at LCS. But like I said, it's interesting because this data is now only through December of last year, and here we are through Q1 of 2026. And anecdotally at LCS, we are seeing quite a bit of deal flow in the first quarter. So it'll be interesting to see if deal count rebounded overall.
Great. Thank you for that. Turning back to Leah. My favorite segment today with Leah is her taking us through the acquisition of a one-person professional services business. So not the typical profile of an independent sponsor's acquisition. It is in the culture consulting, if you will, HR consulting space. It was a service that she actually wanted to layer into her own portfolio and offer to to her PortCos as she builds Marrin. So there was strategic value to her, but still a lot of risk, needless to say, in buying a one-person business. There were subs. This founder would sub out a lot of the service delivery, so it wasn't one person doing all the work. But effectively, there was a single W-2 and a CEO and a book of business, and this is what she acquired. And so we talk about how she mitigated the risk there, what that transition looked like. There was a lot of structure in the deal, as you would predict for something like this with so much key person risk. And I thought it was interesting and relevant because there are countless professional services businesses like this. We don't hear about them because they're probably dismissed out of hand, certainly by independent sponsors, but probably also by searchers and even smaller acquirers. And here you have a counterexample of a sponsor doing it, why she did it, how she did it. And I think it was a great case study and one that kind of opened my eyes to the potential.
Yes, it's almost like it should not be counted as a portfolio company only, but a core capability for her investment shop, because that's really what she was after here. And she also said this is a holding that she expects to hold forever because it feeds strategically into the rest of the portfolio. I thought this was very interesting, and it reminded me of another independent sponsor I came across recently. They were based in the Northeast. The name escapes me, but they effectively buy two types of businesses. They buy professional services businesses and then, more general, normal businesses. But the professional services businesses, they buy to hold indefinitely. And they do so because they service their portfolio. And their thinking is that over time, as they build out a portfolio of professional services companies, that will augment their capabilities as an operator of companies that come in on a 5-year basis. And so I thought that was very clever. And it's a version of the same that we see here with Leah. And this is not a random thought from Leah. She is very deliberate about thinking about HR and culture building. And so we spent quite a bit of time talking about that in the interview. She cites a McKinsey study that suggests companies with strong culture have 4 times higher sales growth rates than other companies. I don't exactly know where McKinsey got or how they did that study, but I think anyone who doesn't have good culture, or frankly, anyone who doesn't have good culture wants good culture. And everyone who has good culture will attribute a lot of their success towards it. So the importance is obvious qualitatively, but it is notoriously difficult to quantify. And I think that's also one of the reasons why you historically see less of it in private equity, because private equity, unlike public companies, are held only on a 5-year basis. And you have to be very cynical and ruthless in terms of where you put your money. And you simply don't have the time for more soft, long-term items like culture often will be bucketed to be. This was a great back and forth. She calls it the 5-year pressure cooker, and she will talk adamantly about why you need to invest in HR. And she has done so not only directly in her portfolio companies, but indirectly through having the capability of a PortCo that specifically services an HR need. So super interesting and quite differentiated. One final note on Leah. She's a fairly new independent sponsor. She's been at it since, I think, 2024, but they already have a handful of portfolio companies. So their pace for closing deals and building a portfolio is quite impressive so far.
Before we get to the interview with Leah, a reminder that here at Minds Capital, we invest equity into independent sponsor-led acquisitions. Our check size is $1 to $3 million per investment, and we average a commitment a month. So if you're a sponsor raising equity for a platform acquisition, submit your deal to us at mindscapital.co. Also on our website, we have our pre-registration form for prospective LPs. So if you are an accredited investor, you can find that also at mindscapital.co. And here is the Minds Capital podcast interview with Leah Berend of Marrin Investment Partners. Enjoy. Welcome to the Minds Capital Podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Leah Berend, of Minneapolis, started her career in small and mid-sized companies, largely unaware of private equity. Through grit and high performance, she made it into boardrooms, serving as CAO and CFO, and eventually learned that the rush of LOIs, the adrenaline of deal closings were well matched to her energy, to her ambitions. She named her son Warren after the Oracle of Omaha and became an independent sponsor when she founded Marrin Investment Partners in 2024. Since then, Marrin's closed on 4 deals, including one just a few weeks ago, and Leah serves as the president of the ACG Minnesota chapter. Leah Berend, welcome to the Minds Capital podcast.
Thank you. Thank you for having me.
So, Leah, your first deal would have been in 2024, so pretty recent. What would you say is your best advice for getting in the game and getting your first deal under the belt?
That is a great question. And I approached it with an open mind when I first got in to entrepreneurship. I explored many different options before I finally executed on that first transaction. It was not right away at all. I think after having hundreds of networking conversations, looking at probably thousands of deals, I really just leaned on some unique strategies in order to finally pull the trigger on that first deal. I think a lot of folks that I run into get kind of that analysis paralysis. I surely did as well. I also kind of dated a couple partners and tried that on for a few moments here and there in that first year just to see who was the best person to run with. I knew I didn't want to do it alone, and so all those things together brought me to my first deal.
And so is not doing it alone, would that be one of your pieces of advice, or was that just very personal to you to get the first deal done now?
Well, it's absolutely possible. I think that I am built for collaboration and partnership. I love to bounce ideas off of folks. I love to have a second voice in the room, a second set of eyes and perspectives. Marrin now has 2 other partners, and that speaks to the collaborative environment that we strive for, that no one person is the be all end all know it all. And so to us, it takes a village to make business happen, to make deals happen. And that's just reflective of how we've structured our own firm.
Great. Well, we have a lot of topics to cover today, but let's stay for now on the theme of this first deal.
Mm-hmm.
Let's dig into it a little bit because there's much more to say about it. You talked about dating some partners, and ultimately you did do the transaction with a particular partner, and it had something of a unique structure. Let's hear about that and then get into the deal itself.
Yes. So, this was a really interesting model, and it came out of the opportunity. So Steve is the CEO of Nutracom, which was our first investment that we made in January of 2025 is when it closed. So we started it in 24 after forming Marrin. And Steve had come to some larger private equity firms with this deal and actually was working with some other private equity firms on a strategy around his 30-year operating history in the food space. And so when he came to me, he had a fully baked, strategy, but together we partnered as co-general partners, which is kind of a unique strategy. Usually it's the general partner with the, call it operating partner, CEO, what have you. And so we really co-general partnered that deal together. I brought the transaction structuring, the deal execution piece, the due diligence side, and he brought the 30-year knowledge in the space, relationships already pre-baked, a kind of a management team. And he knew the business. He had been consulting with them for many years, had known them for many years. And so it was a really, really natural next step for this business. It wasn't like you run a process and you're just going to everyone. It was very much so customized to that particular business.
And so, in fact, you kind of both were looking for partners at the same time. You were looking for a partner for whatever first deal you were going to do, and he was looking for some sort of private equity transaction partner for this live deal that he had.
Exactly.
And so it was almost like he had this live deal and brought you in on it, and that's kind of how the first one came to be.
Yeah, a little bit. So I was certainly out there looking for deals, and it actually happened through ACG Minnesota, where we had gotten to know each other, and it was just kind of this. He had known about the business. He had been kind of talking to other private equity firms. The deal was smaller than what the other firms were envisioning as the first acquisition. It would have made a great add-on to a platform. But for us, doing it together, taking on, a deal that we knew we could get, capital around, financing around. And the amazing part of this deal was that the company was in a little bit of a cash struggle. So it's a contract manufacturer. You have to buy your ingredients quite a ways before you actually recognize that revenue. And so there was a bit of a cash issue, which is what allowed us to get in the first place. But the unique and compelling part of this was that they had a contracted customer coming in who was going to bring the business to a whole different revenue height. And so we worked together to get that cash crunch resolved, get the financing in order, and get the cash cycle making sense. And so by doing that, we were able to bring the company from a much lower run rate in revenue to now where it is. And so it was being able to capitalize on an opportunity and not analyze it to death because it wasn't the perfect opportunity. And I think a lot of people would have said, no, that's not exactly a hockey stick growth rate, and it's not exactly the EBITDA margin I want, therefore it's not a good deal. But for us, it was, what's the opportunity, and can we get the reward to outsize the risk? And we certainly did that with this deal.
Yeah, Leah, a lot of the independent sponsors we talk to will say that they like hair on a deal, a particular type of hair. It's their expertise. And so where everybody else rejects it, they'll run toward it because they know how to disentangle, or whatever the metaphor is, of getting hair off the deal. And so is that the case here, that this particular hair was something you felt well suited to fix, and did it go as planned, essentially?
Yeah, I mean, there were certainly hiccups along the way, especially as we first got into it. We had a management team in place, and there was kind of an immediate shuffling around once we learned, hey, we need that cash flow expertise. That was the biggest thing. And so I took a much more active approach with that first deal, from my background being a CPA and having an accounting background, was to go in and say, okay, let's get this cash cycle compressed so that we're not burning through as much as they were, in order to get to this higher level and start the flywheel spinning of, once you're in that healthier cash position, it's kind of a self-fulfilling prophecy for the rest of the new customers, new business, all that kind of stuff. But it did take a pretty specialized accounting approach, and that was an easier lift for me than it might be for others.
So this was a case where you had to, or you wanted to, improve the accounts receivables and the days sales outstanding. You wanted to lower it sounds like. Is that right, Leah?
Well, it was everything, Nicholas. So, starting from, because they were in a cash crunch, they didn't have terms with their vendors. And so because you don't have terms on your AP, you have an even longer cash cycle until you are actually recognizing the AR on the back end. And so it was, at first, we had this cash, we were going to pay down the AP, but the initial kind of hurdle that we had to get through was, not only do you just have to pay down the aged AP, you have to reset the supply relationships, and you have to say, okay, from now on we want terms. And that has definitely informed future acquisitions for us in terms of when you go in and you're stepping into a new business and you're doing an asset deal, this is a new company, and you can emphasize that to a greater extent with your suppliers to be able to get on new footing with them.
In my experience, I've seen that sellers, this is one of the areas where sellers tend to have more information and a better feel than a buyer, right? They know the pain of having to pay a week early or 2 weeks earlier, or not getting the money soon enough from the customers, right? And so usually they have a feel for working capital items like this at a level that buyers often don't quite appreciate or respect coming into it. But in this case, it was mission critical.
Mm-hmm.
And so you not only identified it, but it sounds like you were able to come in with solutions that the seller hadn't yet implemented. So how did that come about?
Well, I don't think it was that they didn't implement them. The mentality at the time was that their hands were tied, right? They didn't have the capital to reset. They didn't, the amazing part of this is, my partner, Steve, on this deal, who's the CEO, Steve has this unwavering faith that this is going to happen. And I think really set the tone for the entire acquisition. Like, this is going to happen. This isn't going to fail. Our hands are not tied. Even though you feel like your hands might be tied, your hands aren't tied. And so there was this sense when we had come into the business, and we're still, there's very much so part of the culture was kind of this fear of like, well, might close up shop any day, right? It might just all crumble. And you can't run a business, you can't run a turnaround like that. You have to have unwavering confidence and hope that this is going to happen. And so that was really what, working capital aside and strategy aside, that's what was the guiding star. And that's what I, really attribute the success to this of, is that, it's the not willing to let it falter. And I think, obviously there were a lot of nuances to getting the working capital to a point where it was more digestible. It made more sense. We had the right financing partners in line to be able to manage that. But yeah, at the end of the day, it was that guiding star that, had to bring us through.
So this was not a situation where it was a one-time liquidity crunch and a new contract that if we get enough cash to get to this new contract comes into play, then this business is golden. So it was not a one-time cash kind of a shortfall. This was the business operations were wholly unsustainable in that the payment terms on both the receiving side and payable side were not syncing up. And this would be a recurring problem unless it was addressed. And so it wasn't a case where you could just let's bring another half or whole million to closing so that we have enough cash to get through the first 60 days. It was a situation where you had to really address things with the vendors to get better terms and be able to pay them later. And that's how you addressed it. And you had to diagnose all of that before getting into the deal.
I would say that it was more of a middle ground from what you're saying. It was not, the fact that they were in a cash crunch was because this larger customer was coming in. Otherwise they probably would have run at a, lower run rate and been okay. The fact that this behemoth customer was coming in and they had to basically produce all of this material before, getting paid, it was just there was more nuance to it being, you can look at it and be like, yep, it was a temporary cash crunch. Yes, but getting out of that cash crunch created the need to go beyond just putting a Band-Aid on it and saying, what are the intrinsic issues here that we need to work on that, because you could see that it was going to take more than a couple months to get this new customer onboarded. And so it was like, we need to plan for a year to 18 months of a hard of a ramp up period where things could still be difficult. And so I think it was just more of a nuanced thing. And a little bit of it was understanding that, yes, there's going to be working capital needs beyond the acquisition. But until you really get into the acquisition and, see, feel, and touch it for yourself, it's very hard to see how nuanced it was. But at the end of the day, a lot of it comes down to operational discipline. Does this company have the operational discipline to get out of this, whatever issue that's going on, right? And so I think that was more of a thing that was revealed after the fact, right? Because that's a hard thing to diligence.
Can you give us a sense of the numbers in this deal, where it was when you were entering, and what this big contract was, and so forth?
Yeah. So revenue-wise, I can share that. So essentially, we went from about a $15 million run rate to about a $35 million run rate with this new client. So we knew the contracted numbers, right, going into it, but it was just like you don't understand all the nuances, and then you have a culture and a history with people with a lot of wonderful institutional knowledge, but then changing those habits of, and that's what Steve did so well in this deal, was changing those habits of, okay, just because we're in this situation now does not mean we're going to be in this situation tomorrow, and having that guiding star and hope to see the light at the end of the tunnel.
And a year later now, I guess, or you closed in early 25. So I guess a year later. What does the business look like today?
Well, I mean, revenue-wise, it took a little bit longer. There were some more delays that weren't foreseen, and that was on the customer side. And so we're running at that contracted rate now. So it's we've just gotten to that point, and the company's it's a very different environment now. Yeah. When you walk in, there's a lot more optimism, a lot more hope, because they've seen it, and it's a really cool success story.
You mentioned, Steve, that there was a cultural change component to this, not just all of the working capital stuff, and culture has emerged, or maybe it always was really important to you, but it's emerged as sort of a core tenet of Marrin and how you approach your now and future portfolio companies. Take us into that a little bit.
One of my master's degrees is in organizational leadership. And so I got my master's really early on, and I graduated with it when I was 21. So when you think back to Leah being 21 and graduating with an organizational leadership master's, I had a lot of ambition. Not a lot of, foresight to know where I was going to apply that over time. But it set me on a trajectory of knowing that leadership is really important to a company. And the culture, the leadership, sets the tone for the culture. And I also knew that culture eats strategy for breakfast, because I saw that in companies that I worked for, right? You could have the best strategy and the best plan, but if the team wasn't aligned around it, you didn't have buy-in, you didn't have great leadership leading the charge and people who were leaned in, you're never going to get anything done. And so I knew that very intrinsically, having led companies. And when I went into private equity, I was just kind of surprised. I was like, wait, why isn't this being talked about more? Like, we were in these board meetings and talking about financials and all the different operational efficiency things. And I was just looking around and just being like, why doesn't this matter? I just finally got to the point where I was like, wait a second, this is missing. And it should be part of the conversation. And because of the way that private equity is set up, you have this immense pressure coming down, because you have investors that you have to report to, and you have a team that you need to, gather around. And so there's a heightened amount of agility and stress, and, negative or positive. It can be really good. It can be very motivating, but it can also be intensely pressuring. And so I just thought, okay, so you're in this pressure cooker, and if somebody's not taking care of the culture and like looking at the whole perspective of like, how are the employees doing during this immense time of, you're investigating every metric, you're diving into things, you're trying to create value in places that have never even been looked under to create value. It just adds this piece of like, well, if no one's acknowledging it, you could err on the side of negative really quickly. And I've seen that. I've been a part of an M&A transaction as an employee. And so I've felt that myself. And so I just knew that there was this unmet thing that was going on in business that I wanted to address. And McKinsey states this, right? When you have a strong employee culture, your revenue is 4 times higher than that of your competitor down the road that doesn't. And so to me, it was like, okay, not only is this an important intangible, but it's actually translates into a very tangible piece of value creation, if not the most important piece of value creation. And so when I set out to start Marrin, I knew that piece, that felt like it was missing, needed to be incorporated because the employee culture and the employee experience is just too important. Not only that, we have a very changing demographic. I mean, the manufacturing firms we acquire have aging workforces at times, right? You're dealing with a very large generational change that's happened. And I tend to look at the future and say, okay, well, if that's happening and we have less people replacing out, our baby boomer generation, people become more important to business, not less important to business. Even if AI took half the jobs, those jobs that are remaining are even more important because not only do you have to program the AI, you have to have critical thought to be able to understand what the AI is saying and doing, right? So to me, with that future-looking perspective, I know that employee culture is becoming and it will become even more important to how you conduct your business because it's a fight for talent now. And that mindset of saying, okay, how do we create cultures that people want to work at? Because life is too damn short to work in a job you hate. And you spend so much time working and more time with your coworkers than you do with your family. It's just too important to ignore. So that was a very big tenet of Marrin and what we focus on very tangibly to be able to deliver a different experience when you're going through a private equity transaction.
Well, one of your acquisitions is all about this and bringing culture and bringing kind of the human capital perspective to your acquisitions and others. And we're going to get there in a sec. But just before we do, why do you think it is ignored or overlooked by private equity culture?
It's harder. It's easier to make decisions based on a spreadsheet than to look at all the nuances and say, yeah, I'm gonna make some people mad, but I want to do it in the right way, or I want to negotiate, but I don't want to make it feel like a war. It's just easier to default into that, like pound your fist on the table. This is what I want, and try to pressure it and to make it happen. And it takes a lot more experience and having hit your head against the wall a number of times to understand that in order to get the results that you're seeking, you have to allow others to be lifted up and to come to the conclusion themselves and not to be the one forcing it down their throats. Because I think people genuinely will get there better, and you'll have more true buy-in if you're able to let them do the work to get there. But it takes longer, and it's it truly is a little bit more difficult, and is might even take longer, time as well.
But there's no shortage of savvy business people who will do the hardest things and work the greatest extents to pursue a good ROI. And so if culture does, as McKinsey says, 4x your revenue over time, wouldn't you think that business people, especially investors pursuing a return, would be more on the ball here?
I think that's a really insightful question. I think that the way a deal is structured has an effect on how you're thinking about things. Because if you only have a 3-year hold or a 5-year hold, you're having to reverse engineer all that change. And not only that, but private equity, in my perspective, I've been doing it for, longer than 2 years, but enough time where I know that I'm a new entrant to it. And from what I hear from the good old days, where you could just financially engineer something and put 75 to 85% leverage on it and call it a day and make a great return, I just don't think that's happening anymore. I think that private equity has to do more work to create value and make sure that that stewardship is happening nowadays. Not only that, so you have these hold periods that create the pressure to get quick, faster returns. And that doesn't always bode well with, okay, I need to lean back and take the time with this team so that they understand and they come to the conclusions about how we're going to grow and, we get their buy-in. So they're kind of a little bit at war with each other in terms of, just how it's structured.
I agree with that. I think the whole period that is so defined and the incentives that are so descriptive, if you will, with the investors and the management team, they do come to some extent at the odds of building a long-term culture and long-term revenue engine. You're more looking for the quick wins, not as quick as public markets where they count in quarters, but you'd still count in, Olympic intervals 4 or 5 years. Now, I wonder if another part of the explanation, however, is just that the link between value creation and culture building, just for all the efforts of organizational leadership academics, it just isn't direct enough or clear enough. It's very clear to people who are on the other side of it. People who have built cultures will always trace their success back to that and the team and the people side as a key factor. But for people on the front end, who have a 5-year time span, it's just not among all the million priorities they can have a clear enough or direct enough line that they can throw resources into it or have infinite patience with building in that way. So I think it's just one of those chicken and egg situations.
A little bit. And I think this goes into our acquisition of human capital partners, in that I knew I had to put in tangible ways to enhance the culture that weren't that expensive, that weren't prohibiting the other pieces of value creation or the financial engineering or the cutting back costs. And so I knew I needed to do it a different way, because like you have probably seen and I've seen, you have a lot of people giving platitudes to how important culture is, but then when the rubber meets the road, it's nowhere to be found. And that happens in every business, right? Private equity, public, privately held companies. That's just where the buck stops. And so I knew that I had to do something differently in order to start to directly tie what does it mean to have a strong employee culture. And, it's not necessarily spending on, trips for your sales team or, whatever the high cost culture building thing du jour is, that you can, pay somebody to enhance it. The true value creation of a strong employee culture does not come from outside consultants.
Human capital partners. You just mentioned that you acquired. It's a small company, but you view it as something that you will hold permanently. And it was less for the direct growth and benefit and ROI of that particular asset, but more to be a cornerstone of your portfolio and an asset and resource for your firm overall as you implement HR and improve culture across your portfolio companies. Can you tell us a little bit more about the strategic angle here and how you found it and how you think about it as a cornerstone in your business?
Yeah. Well, I think of it as an ecosystem type business, and Marrin seeks to acquire other ecosystem type businesses. But this one was very, very important to me personally and to the mission of Marrin. I came across Human Capital Partners late 2024, I want to say. And again, I knew that I had to put my money where my mouth was and take action towards building out things that would enhance employee culture, better than just talking about how important it is. Human Capital Partners actually does outplacement services. So when a company does a layoff, they come in and do the coaching and helping the affected employees build back their resumes, build their LinkedIn profiles, do coaching around, the effect that this had on their livelihood and their life. And so it's just this beautiful little business that has a very positive effect everywhere it goes. And they take a very white glove approach to, low ratios between coaches and affected employees. And so it's just a very special type of business. And not to say that Marrin is doing all these layoffs. At some point, you have to transition an employee for one reason or another. But part of the idea behind Human Capital Partners is that it is so important to treat employees with dignity, whether it's on the way in or whether it's on the way out. And that resonated so deeply with me in terms of how the culture is built, that people are treated as humans with livelihoods and lives outside of work, and that Human Capital Partners and the amazing coaches that are part of it could plug into our portfolio companies in a variety of different ways. Not only, when a transition takes place and somebody is, shared with the competition, but also that they're able to do executive coaching, they're able to do group coaching, they're able to do coaching around, how do you build that culture to begin with, but then also any type of transition services, search, and just internal things that we can use those coaches for. And so,
do your portfolio companies pay HCP for these services? Is that kind of built in?
It's not built in. It's not like a formalized process, but we do utilize it. And I'm always recommending. Okay, what are ways that we can help, that Human Capital Partners can plug in and help here, because it is just an amazing resource. In addition to the fact that they're serving their clients in a really in-depth way as well. And so for me, we have some bigger plans that haven't been implemented yet, but it's starting point, because I knew that this little company, we brought in outside investors, and I said, look, I want to hold this company forever. I'll buy out the investors over time. But to me, it's so important to have a flywheel for how do we create really strong teams within companies? How do we transition employees well? And how do we enhance that employee culture? And not only that, right, but at the board level and at the management team level is really where the onus comes when you're trying to enhance the employee culture. Because if that CEO isn't singing that same song of how important the employee culture is to your organization, you probably don't have the right CEO in place. And so to me, it was, we have to plug in resources at every level, but especially that leadership piece of making sure that they understand that this is a different type of leadership expectation than forcing your way through growth. It's really very nuanced and takes a lot different kind of leader.
And I have to imagine this plays into your positioning and your differentiation as well as a business owner. So when you meet a business owner today, a new seller, hey, I'm Leah. not only do we provide you with a lot of leash and encourage you to build culture and care for the people, our entire mission is people first. And to that end, we have a portfolio company, an asset, a resource that will be available for you and your team that provides all of these services. And that's integrated into the package of partnering with us.
Mm-hmm. Yeah. And several other private equity firms, this is not an original idea, right? Several other private equity firms have done this where they have businesses plugging into other businesses and create, more of an ecosystem to do that. And we'll do the same, maybe with an accounting firm, maybe with a consulting firm. But to us, it was just really important to get this one in and starting to build it towards creating a broader picture of like, what does it actually mean? What does it actually mean to do this well?
What do you mean you'll maybe get an accounting firm or consulting firm down the line? What's your vision there?
Yeah, I mean, same buy and hold type approach where every business can be enhanced by, those services, and obviously, it helps the portfolio in a lot of ways. It can serve outside companies as almost a vetting tool, but to me, it's just how do you plug in, and especially as we go into these core businesses and start to really align our focus around, okay, we like manufacturing, we are creating a lot of value in these manufacturing companies that we're acquiring, if we have partners, and again, this goes back to my original, I needed to collaborate. I wanted partners. If we have partners that know what we're going for and have the professionalized playbook of what is the board looking for, what are the metrics that we're measuring to, all that kind of stuff, you kind of create the playbook by having this revenue engine in addition to, kind of turning it from a cost center to a revenue engine.
Leah, the Human Capital Partners was actually a solopreneur. It was a one-woman show.
Mm-hmm.
Let's get into the mechanics of buying such a small business and how you can make that work and how you can deal with the key woman risk and how you make it put it on firmer footing for the future. As you said, it's a forever hold, a permanent hold for you.
Yeah. Well, in professional services, firms deal with this a lot more than a manufacturer.
Yeah.
Right. And so if you're an independent sponsor looking at a professional services firm, you have to realize that, so many of those key relationships begin and end with that entrepreneur in that seat who started the company. And in order to do it well, there's several aspects that professional services entrepreneur can do to strengthen that, and lessen the key man risk, whether it's, scaling and things like that. In this certain scenario, she had this wonderful little lifestyle business and, a number of clients that she kept in contact with. And it wasn't a growth play for her. It was, hey, I'm gonna do this while I'm raising my kids, and then I'm gonna, ride off into the sunset someday. But she knew she wanted to sell the business. And so and appreciate some of the value that she had built. And so for us, I was looking at it like, wow, I mean, this is a company that has great margins, blue chip customers, a lot of really strong things, but and compelling investment reasons, but also we had to balance, to me, it's all about asymmetric risk reward. How do I outsize the reward to the amount of risk that I'm taking? And we did that in a number of ways, just in terms of structuring the deal so that it felt more aligned and that we could work together for a period to transition relationships, to bring in a new leadership. All that kind of stuff was really important to buy us some transition time and structure it around that so that, you didn't lose all the customers day one after the acquisition.
And so you hired people to be the account managers, if you will, because she wasn't doing the delivery of the service.
Correct.
She was managing the relationships and then had a team of subcontractor coaches that would actually go and do the the outplacement work.
Yes.
And so what you did was replace what you were the key person to replace, or roles to replace, were that kind of account management function.
Essentially, yeah. So she was in as the CEO. We moved her over to a president role. We actually brought in a CEO right from day one of the acquisition. That did not turn out just in terms of a fit for the CEO who had come in. I think it was a lot different than what she had originally thought. And so we made a very quick decision to say, okay, we're gonna pivot to bringing Jane, who's the seller, back in. And so we didn't skip a beat in terms of repositioning. And then it's since been a journey to get that right CEO in place who was going to, kind of take the reins and grow it, which we took our time on, and we wanted to do really thoughtfully the second time around. Because that often happens, right? When you're running quickly towards an acquisition, you have to vet the deal, you have to raise the capital, you have to do the due diligence, all of it. And then you're bringing in the leadership team to run it. And so I think for us, what we thought was going to be a great fit was just something that we had to pivot from. And that's, has ended really well for both parties. I have nothing but good things to say about that CEO. And she did great. I think it was just a mismatch in terms of what the expectations and skill set was. So for us, we've pivoted. We have a new CEO coming in, and we still, luckily, with the way we structured it, we have some time to continue that handoff with our president, Jane. And I think a big piece of this has just been the transparency, the openness, the working together aspect of this. That it's to me a lot of pressure because I brought investors into this, and so I want to do right by them. I want to do right by Jane, it's been a journey to make sure that professional services firm lives on beyond her involvement. And we structured that with kind of a combination of earn-out, seller financing, and then a consulting agreement to just kind of bolster that structure so that we could feel confident that even with that hiccup of not having the right CEO in the seat from day one, we were still able to have enough time to transition the business well.
And this experience, how do you feel like how does it make you look at professional service acquisitions in the future? Is it something that now that you're developing, you have one rep under your belt, you're working through it, that it's something that you revisit? Because this one was sort of all about getting the human capital piece into the DNA right. of Marrin. It wasn't so much because you wanted to go out and buy a professional services firm. But maybe now that you've done it and you've worked through as you put it, the precise weakness that these classically have, which is the key man or woman risk. Could you develop a thesis around it? Professional services.
Yes, absolutely. There's so much value that this company has that would, because often the argument is, do I just go start my own? Right. What are the barriers to entry?
Easier
right?
to build than buy. Yeah,
exactly. And so if you can find enough of those defensible reasons why and again, outsize the reward to the risk, to me, it's very compelling. I think that there's a lot of professional services firms that are changing hands right now. I mean, I see it, and which is why this whole podcast exists. I'm sure there's a huge transition happening with businesses right now, and a lot of really strong reputationed businesses that will continue into perpetuity, but you have to structure it right. And you have to say, look, like this relationship piece is so important. The humans in this business, and what I talk about culture, it's even more prevalent with professional services firms because, your employees could walk out and start their own, right? And so you have a very delicate balance with professional services of saying, that the people are such an important piece of this. And so you treat that with a lot of reverence. And I think structuring it with that reverence puts it into a much better puts you into a much better position for coming out with a win at the end. That you're not, because truthfully, if I would have done this wrong, I could have lost value day one. And then what are you doing with investor dollars at that point? So I think that it takes a lot of carefulness when you're structuring these to be able to share that risk between you and the seller. And I think seller financing does a good job of that. I think earnouts do a good job of that, just to be able to create more connection between you and that seller who's handing off the business.
And to be clear, those were the two big pieces of the structure that you would recommend to other sponsors. Just the kind of classic risk mitigation by sharing the risk with the seller.
Exactly.
Earnout and seller financing.
Yep.
We have you for just a few more minutes, Leah. Can't let you go without talking about your podcast.
Yeah.
Since here we all are, podcaster to podcaster. Tell us first what the podcast is, and then we'll want to hear kind of why you've done it and how has it added value, and what other sponsors might learn from your experiments there.
Awesome.
So what is the podcast?
So my podcast is called The Future of Private Equity. I started out with a podcast called People of Private Equity at my old firm that I worked with, and I couldn't take that name with me. It was their intellectual property, and so I had to come out with my own brand. So pivoted from People to The Future of Private Equity, which to me is human culture, is people. And so we talk about a variety of different things for both business owners and the deal community, talking about experiences that people have had, how to get through an investment banking process better, what advisors to use where, developments in the transaction space, technology that enables M&A to happen faster, more efficiently. So we cover a variety of different topics, all with the onus that people are what makes this happen. Organizations are built out of people, and to me, it's just so fun to be a podcaster because you get to cement relationships and you get to really get to know somebody on a deeper level. And I just love that piece of being able to share those conversations with my community.
And so are you doing it to form relationships with your guests? Is that sort of the North Star?
I think it's just deepening relationships. And it's been really cool to see that. I mean, I had Jennifer Zick is a good friend of mine now. She was on my podcast. She founded Authentic Marketing. And I had her on my podcast to talk about her professional services firm, her plugging into M&A, into private equity. And since then, she's now a board member at one of our PortCos. We've done a number of different things together. She's on the board with me at ACG, Minnesota. So it's just been a really cool thing to be able to cement and deepen relationships in the process.
We had talked a little bit in the pre-call about the frequency. And so our approach is doing it religiously, putting out an episode every week, every Wednesday. Whereas yours, and in fact, many podcasts are more sporadic. You kind of, you do it, I guess, when there's a good guest opportunity or when you have a topic you want to talk about. How do you decide on when you want to put out a new episode? And what does that frequency end up being roughly? I know it's loose.
Yeah, it's sped up and declined as I've been building the business because, when you're an independent sponsor starting something, I mean, you're an entrepreneur. It truly is the entrepreneurial journey. And so I intentionally didn't want to create an expectation for my following that I was going to have something out every week just because I don't want to disappoint them. And knew I couldn't live up to that standard. So probably every month, every couple months, I come out with a new episode. And a lot of it, stemmed originally just because it's like I get to have all of these amazing conversations. And man, if I could have been a fly on the wall 10 years ago listening to these conversations, I would have just developed and grown so much. And so that's really what what it is like, hey, like you should definitely be on my podcast. And then we, create an outline around it and make it happen. But to me, it's just the simplest way to not only deepen relationships, but also share some thoughts that aren't, I don't see a lot of private equity firms talking about this. And so I love to be a voice and a thought leader around making sure that employees know how valuable they are and how it plays into the future.
Absolutely. I mean, what better way to evangelize a message that you're trying to get people to pay attention to? And have you seen any aside from the relationships that you've fortified with the guests, have you seen any other benefits in terms of like the impact of your message or deal flow or anything like that?
I think deal flow has been wonderful just due to a variety of different factors. There's so much that I can't attribute to the podcast, right, for that. I mean, I have an amazing originations partner that knows everybody in town. And, we have so many amazing people in our community here. Minneapolis has been through a lot in the last 6 years, but the community is so rich. And we have some very deep relationships that call us with deals and things like that. So we're very, very fortunate to have a ton of deal flow due to a variety of things. But I would say the podcast, if anything, it helps sellers and people around me get to know me a little bit more. And so it kind of does that work, which is so helpful because then we're able to go deep right away.
Well, that's right. When you're talking to a seller and they're vetting you and they're Googling you and this comes up and they can listen to literally hours of your conversation, though it'll accelerate how quickly they can get to know you. And
I often tell sellers, you need to do as much diligence on me as I'm doing on you. And that's just, to understand who your buyer is a great tool for them to be able to enhance their confidence in getting a deal done.
Well, Leah Berend, the name of the podcast is The Future of Private Equity, and Marrin Investment Partners is the firm. We'll link to your URL there. We'll link to your LinkedIn, and we'll link to the podcast. And we thank you for coming on our podcast, Leah Berend.
It's such a privilege. Thank you so much, Nicholas and Will.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraises. See you in the next episode.